Usually when the CME sends out a clearing notice on a Friday afternoon, it's just paperwork. It's the kind of thing you archive without reading because you're already looking at the weekend. You're watching the close. You're watching the tape slow down. But this afternoon, when notice 26-057 hit the wire, the room went quiet. Not because it was a surprise. We knew they were nervous. We knew volatility was running hot. But it was the specific number they chose and the specific time they chose to enforce it. 18%, effective after the close February 6th. Now, if you're just reading the headlines on your phone, you might think, okay, so what? They moved silver margins from 15% to 18%. That's a 3% hike in a market that just moved 10% today, swinging from $65 up to $75 in a matter of hours. 3% sounds like a rounding error. It sounds like a safety valve. But that is exactly where most people get trapped. I was looking at the open interest numbers when this crossed. I was looking at the leverage ratios on the shorts. And I realized something that I don't think the retail crowd has priced in yet. This isn't a safety valve. When you move margins to 18% on a contract trading at these valuations, you aren't just trying to cool down the price. You are mechanically changing the structure of the market. You are drawing a line in the sand that says, if you don't have this much cash, you don't get to have an opinion anymore. We have seen this playbook before. We saw it in 2011. We saw it in 1980. But there is a very specific difference in how they did it today. A difference buried in the transition to percentage-based margins that started back in January that makes this situation dangerous. I don't use that word lightly. Most people are looking at the chart and asking if the bottom is in at 65. They're drawing trend lines. They're looking at Fibonacci retracements. I'm telling you, none of that matters right now. Because while everyone was arguing about the price of silver, the exchange just quietly changed the cost of admission. And when the market opens on Monday, a lot of people who thought they were holding a long-term position are going to wake up to a forced liquidation notice. I want to walk you through exactly what just happened, not the headline version. The plumbing version. Because if you don't understand the mechanism of this 18% hike, you are flying blind into next week. Let me show you what I see. You have to understand the specific mechanics of this squeeze because it's not what we saw 5 years ago. It's not even what we saw last month. For decades, if you traded silver, you knew the margin was a fixed number. Maybe it was $9,000, maybe $12,000 per contract. It was a static hurdle. You knew where the line was. But remember what happened on January 13th. That was the day the rules quietly changed. The CME moved from that fixed dollar amount to a percentage-based margin system. They told us it was to better reflect volatility. It sounds reasonable, it sounds efficient, but here's a reality of what that change actually did. It weaponized the price against the leverage. Under the old system, if silver went up, your margin requirements stayed flat. You had more room to breathe, your account equity grew, but your rent to stay in the trade didn't change. Now success is a liability. With silver trading near $75 and the margin requirement jumping to 18%, do the math on a 5,000-ounce contract. You aren't just looking at a higher price, you're looking at a moving target that expands every time the price ticks up. If silver rallies to $80 on Monday, your margin requirement doesn't just sit there, it inflates. It chases you. This creates a paradox that I don't think enough people are talking about. Usually, margin calls happen when you're losing money. You're wrong, the market moves against you, the phone rings, and you have to pay up. That's standard, that's fair. But under this 18% regime, you can be right and still get liquidated. Think about that. You can be long silver, the price can go up, you can be sitting on a paper profit, but because the cost of maintaining that position is rising in real time alongside the price, if you don't have the free cash flow to cover the expanding margin requirement, the exchange doesn't care that you picked the right direction. They will liquidate you at the market price to protect the clearinghouse. We saw hints of this today. When silver dipped to $65 in the Asian session, that wasn't just profit-taking. That was mechanical failure. That was the sound of accounts that were leveraged to the hilt hitting a wall. And then when we ripped back up to 75, that wasn't just buying. That was a vacuum. And this is where it stops making sense if you're just looking at a standard chart. Normally, when margins get hiked, you expect open interest to collapse immediately. You expect the weak hands to fold, and you expect volume to dry up as people step back to reassess. That isn't what happened today. I was watching the tape into the close. Volume didn't dry up, it accelerated. And open interest, the total number of outstanding contracts, didn't drop as much as it should have. What does that tell you? It tells you that the people selling, the people getting forced out, were being instantly replaced. But they weren't being replaced by other speculators. They were being absorbed by entities that don't care about an 18% margin. If you were a massive bullion bank or a commercial hedger or a sovereign wealth fund using the futures market for delivery, 18% is nothing. It's a cost of doing business. You have the balance sheet. You can swallow that hike without blinking. So the net effect of what the CME just did isn't to kill the silver rally, it's to gentrify it. They are effectively evicting the retail speculator, the guy trying to turn $10,000 into $100,000, and handing the keys over to the institutional players who can afford the higher rent. And this is where most people get trapped. They see the margin hike, they hear margin tightening, and they think bearish. They think the exchange is trying to crash the price. I don't think that's it. If the CME wanted to crash the price, they would have hiked margins to 25 or 30% overnight. We've seen them do it. In 1980, they hiked it so high it was effectively impossible to buy. 18% isn't a kill shot. 18% is a filter. It's designed to shake out the noise. It's designed to stop the guy trading from his phone on 20x leverage from blowing up the clearing firm. But it leaves the door wide open for the whales. So if you're holding a position through this weekend, or if you're planning to jump in on Monday thinking this is a dip, you need to look at one specific ratio that is flashing red right now. It's not the gold-silver ratio, and it's not the dollar index. It's the ratio of managed money longs to commercial shorts. Because right now, the managed money, the hedge funds, the trend followers, they are loaded to the gills. They are the ones holding the bag that just got 3% heavier. And the commercials, the big banks on the other side, they are net short. Now, usually people say, oh, the banks are short, they're going to get squeezed. Maybe. But when the exchange raises margins, who feels the pain first? The bank with a $1 trillion balance sheet or the hedge fund that has to report performance to investors at the end of the month? The pressure is entirely on one side of the boat, and that creates a very specific type of volatility. It's not the fun kind where everything goes up in a straight line. It's the whipsaw kind. It's the kind where the market flushes 10% down to clear out the leverage, then rallies to new highs once the weak hands are gone. We call this a transfer of inventory. The inventory is moving from weak hands who can't afford the volatility to strong hands who are buying the liquidation breaks. And that brings me to the most dangerous part of this setup, the timing. Feb 6th, Friday. They made this effective after the close. That means everyone has the entire weekend to stew on it. Every trader who is borderline on their margin maintenance is going to spend the next 48 hours doing math on a napkin. They're checking their cash balances, they're looking at wire transfer limits, and a lot of them are going to come to the same conclusion by Sunday night. I can't hold this. So when the Asian markets open on Sunday evening and when London opens on Monday morning, we aren't just going to see trading. We're going to see a forced reconciliation of accounts. But there is one mechanism, one very specific structural detail in the futures market plumbing that could turn this Monday morning flush into something much, much bigger. It has to do with how the stops are clustered below $65. And this is where the mechanics get brutal. When I say clustered stops, I'm not talking about mental stop losses, where a trader thinks, oh, if it hits 64, I'll get out. I'm talking about algorithmic liquidation levels. You have to imagine the order book like a dam. Above $65, you have all this water, all these leveraged long positions holding on, paying that new higher margin rate. But right below 65, the water disappears. The order book is thin. It's hollow. Because everyone who bought the breakout, everyone who chased the momentum last week, they all put their safety net in the same place. So if we open on Monday and we get a little bit of selling pressure, maybe just enough to push us down to $64.80, we trigger the first wave of those automatic sell orders. And here's the mechanism that people forget. In a thin market, when a massive block of market sell orders hits the tape, it eats through the bids instantly. The price gaps down. It doesn't trade down, it teleports down. And that gap triggers the next wave of stops at 64, which triggers the margin calls for the guys holding a 63. It becomes a feedback loop, a liquidity cascade. The CME knows this. That is why they raised margins. They're trying to force people to deleverage before that cascade happens. They want you to sell now voluntarily rather than get liquidated later chaotically. But here is the signal that I think most people are completely misinterpreting right now. If you look at the forums, if you look at the social sentiment, everyone is screaming manipulation. They're saying the banks are trying to suppress the price. I actually think it's the opposite. I think the banks are trying to ensure the market survives the price rise. Look at the exchange for physical volume. This is a bit technical, but stay with me. It's the only way to see the real flows. EFP is basically a mechanism where big players swap futures contracts for physical metal in London. Usually, when the futures price dumps, EFP volume spikes. It means the smart money is using the paper dip to grab physical bars. Today, though, EFP was quiet. Too quiet. That tells me the big physical buyers, the industrial users, the sovereign mints, they stepped back. They are not catching this falling knife yet. They are waiting. They know the margin hike is going to flush out the tourists, and they're waiting to buy the carcass of this trade at a discount. So we have a situation where the paper price is being squeezed by the exchange, and the physical bid has temporarily stepped away. That leaves a vacuum. And in a vacuum, volatility doesn't just double, it squares. This brings me to the difference between what looks important and what actually moves the P&L. What looks important is the headline price, $75. Everyone is fixated on that number. Is it an all-time high? Is it a breakout? But what actually moves the outcome is the cost of carry. If you are a fund manager holding silver futures, you are paying interest on the borrowed money. You are paying roll costs to move to the next month, and now you are posting 18% collateral that earns zero yield. Holding silver just became expensive. So the question you have to ask isn't, will silver go to $100? The question is, can the current holders afford to wait for silver to go to $100? Time is now working against the bulls. Every day the price goes sideways is a day where that capital is dead capital, and institutional money hates dead capital. They will rotate out. They will move to bonds or tech or something that is moving. Now, I want to pause here. I want to be intellectually honest with you because I see a lot of analysts who refuse to look at the other side of the trade. There is a scenario where I am completely wrong about this flush. If we open on Monday and despite the margin hikes, despite the cost of carry, we see silver rip straight through $80 on high volume, then my entire thesis about a liquidity flush is invalid. If that happens, it means the buyers aren't leveraged speculators. It means they are cash buyers. It means there is a panic bid for physical assets that is so strong, so desperate that it completely ignores the cost of financing. If we see that, if we see price ignoring the mechanics, then we are not in a trading market anymore. We are in a currency crisis, and that is a totally different game. I don't think we're there yet, but if I see $80 on Monday morning, I will tear up this script, and we will have a very different conversation. But assuming we are still in a functioning market, we are looking at a binary path for next week. Path 1, the healthy flush. We drop. We test 62, maybe even 60. The weak hands get washed out. Open interest drops by 20%. The fever breaks. And then, slowly, the physical buyers step back in, and we grind higher on a solid foundation. That is the bull market continuing. That is sustainable. Path 2, the broken ladder. We drop, but no one steps in. The margin calls trigger a liquidation event that spills over into gold, spills over into miners, and creates a margin contagion where funds have to sell good assets to pay for their bad silver positions. If we see gold start to drop because silver is crashing, that's the danger signal. That's correlation going to 1. So as we head into the Sunday open, I am not watching the price of silver in a vacuum. I am watching the spread between the bid and the ask. When that spread widens, when it costs you 50 cents just to enter an order, run. That means the liquidity providers have left the building. And right now, looking at the after hours book, the spread is widening. When that spread widens, it means the market is losing its shock absorbers. So let's play this out. Let's look at the scenario tree for Monday morning, because you need to have your decision nodes mapped out before the price starts moving. You cannot do calculus when you are staring at a falling red candle. Here's the first scenario I'm watching for. I call it the capitulation wick. We open Monday, maybe down 2 or 3%. The margin calls go out at 8 a.m. By 9:30 a.m., the selling accelerates. We see a violent, vertical move down. Maybe we touch $62, maybe even $60. But, and this is critical, the volume on that drop is massive. It looks like the end of the world. If you see that, that is actually the bullish case. I know that sounds insane, but a high volume crash on a margin hike is a cleaning event. It means the leverage is being wiped out in one go. It means the weak hands are vomiting their positions and the market is finding a true floor. If we see that massive red candle followed by a quick recovery where price snaps back up, that is a buy signal. That is the market telling you the flush is finished. But there is a second scenario, and this one is far more dangerous. The slow bleed. We open Monday down slightly. The market feels heavy. It drifts. There is no panic. There is no massive volume spike, just a slow grinding decline. 64, 63.50, 63. This is the worst possible outcome because it means the leverage isn't clearing. It means traders are meeting the margin calls. They're digging into their savings, selling other assets, and feeding the beast to keep their losing positions alive. They're hoping it turns around. This creates an overhang of supply that can last for weeks. Every time the price tries to rally, one of these trapped traders says, "Thank God I can get out at break even," and they sell. It creates a ceiling that suffocates the price action. If I see a slow bleed on Monday, I am not touching this market. I'm stepping back because a slow bleed usually ends with a sudden death. Eventually, the money runs out, and the crash we should have had on Monday happens on a Thursday afternoon when no one is looking. So what is the playbook here? What do you actually do? I'll tell you exactly what I'm doing, and more importantly, what I'm explicitly not doing. Number one, I am not buying the first dip. The buy the dip muscle memory is very strong right now. We've been conditioned for 2 years that every drop is a buying opportunity, but a margin-induced drop is different. It's structural. The floor has moved. Buying the first red candle on Monday is like trying to catch a falling knife before it hits the ground. Let it hit, let it clang, let it settle. Number two, I am watching the commercial net short position. This data comes out in the Commitment of Traders report, but you can see the proxy for it in the daily open interest changes. If silver drops $5 and open interest drops significantly, that means the banks are covering their shorts. They're taking profit. If the banks are covering, the pressure is off. We can go higher. But if silver drops $5 and open interest stays flat, that means the banks are pressing. They aren't done. They smell blood, and they are going to drive this down until every last retail speculator is broken. Number three, I am watching the paper versus physical divergence. If the futures price crashes to $60, but the premium on physical coins and bars jumps to $10 or $12 over spot, that is the bottom. That is the physical market screaming that the paper price is fake. That is when you step in with both hands. But we aren't seeing that yet. Right now, premiums are flat. The physical market is calm. So my stance is simple. Cash is a position. I know, it's boring. It doesn't get clicks. But right now, sitting on your hands is an active trade. You are preserving your capital for the moment the opportunity becomes asymmetric again. Because at 18% margin with volatility at these levels, the asymmetry is gone. You're flipping a coin. And I don't bet my capital on coin flips. I want to see the flush. I want to see the panic. I want to see the retail crowd surrender because that is the only way this market resets for the next leg higher. If you are holding a long position right now and you're feeling sick, that is the signal. That feeling in your stomach, that is the same feeling everyone else has. And the market is a mechanism for maximizing that pain before it releases. We are in the pain maximization window. So Monday is not about making money. Monday is about survival. It's about watching the structure. I want to leave you with one question. And I don't want you to answer it in the comments. I want you to answer it for yourself in private, looking at your own account. If silver opens at $62 on Monday morning and it stays there for a month, does your thesis survive? If the answer is no, if you need $75 to make the math work, or if you are paying interest on a position that is underwater, then you are not an investor right now. You are liquidity, and the market is very good at finding liquidity and harvesting it. There is a lot of noise out there saying this is the end of the manipulation. I see the comments, I see the anger, and I get it. It feels unfair when the rules change in the middle of the game. But if you think this is just a rig, or if you think I'm missing the physical supply crunch that makes the paper price irrelevant, tell me why. I want to see the counterargument, but give me the mechanism, don't give me the slogan. Tell me who steps in to buy 5,000 contracts on Monday morning with margins at 18%, because I don't see them. I'm going to spend the weekend breaking down the Commitment of Traders report that just dropped this afternoon. It covers the positioning up to Tuesday, before this hike hit. It shows us exactly how many longs are currently trapped in the burning building. I'm going to map those positions against the new margin requirements to calculate the exact dollar amount of forced selling we should expect. I'll have that number for you before the market opens. Watch your leverage.